Hi, everyone. My name is Damian Gallagher, and I'm coming to you live from Emerald's 31st Annual Groundhog Day Investment Forum. With me, I've got Portfolio Manager and Senior Research Analyst Steve Russell. Steve covers the financial services sector for us and is a manager on our Finance and Banking Innovation Fund. He's been with Emerald for actually over 25 years. So thanks, Steve, for taking some time out of the day to talk with me right now.
Of course.
Just wanted to ask you a couple of questions in between panels here. So financial services, certainly a lot happening in the last decade and really further than that. But can you talk about what innovative things you're following today that are impacting your area of coverage?
Sure. There's been a lot of technology that's driven some differences or some changes that have happened in the payment space. We think that's been really exciting. We think there's a lot more to happen there as well. But certainly, B2B payments has been key to the industry. We think that's going to continue to grow. There's very few entities that are actually collecting cash now and having cash runs to the banks at night. A lot of things have gone to digital transactions. We think that's going to continue. We think the payment services and treasury management becomes more and more of a revenue generator for the banks. So we're really excited about that. The digitization of money, we think benefits them, makes the banks a lot more efficient. And we think that's only going to grow from here. I think the day of carrying physical dollars, I tell people all the time, I used to go to the ATM machine at least twice a week. And I think I go maybe once a month now. And it's only there just because I'm like, at some point, maybe I need to have a digital dollar. I think it's going to be the same way for businesses moving forward. And we continue to see the amount of digital transactions continue to increase. And we think the technology gets better and better. And then all that data goes into a data warehouse. And we think that data pool can be used with artificial intelligence to really drive more efficiencies at the bank, help them with underwriting. If you look at the 5 C's of underwriting, one of the things is character. And that's always been something that had to have a human interaction. But they also look at capital and collateral, and they would look at market conditions and things of that sort. But that character aspect was always very difficult for them. And we think AI opens up the opportunity for them to evaluate the character of a business or an individual in that underwriting process utilizing AI. And we think will make the underwriting process a lot more efficient and a lot more analytically driven.
Okay. Well, great. That's all great. I just kind of want to continue on that theme of efficiency,
Sure.
Especially because we're starting to see more, I guess, attractive valuations across the banks and in the financial services sector. What are you seeing in terms of M&A activity, and where do you see that driving, I guess, growth into 2024 and beyond?
Sure. So, M&A is going to be a key opportunity in the banking system and for bank investors. And we think that's driven, one, the regulatory expense, the regulatory burden isn't going to go down. We also think the spend that's necessary to keep up with technology, that's not going to go down. And I say spend, it's really tech investment now. We have to look at it as tech investment, not tech spend. M&A was slower last year because you saw some of the valuations on the banks come down. And there were other issues with the bank balance sheets, with their securities portfolios and things of that sort. But we think as that starts to normalize, we'll continue to see the M&A activity normalize as well. So prior to 2023, we saw about 4% of the banking industry was being taken out on an annual basis. We think we get back to those levels. We think valuations of the takeouts increase again. Basically, on average, the takeouts last year were at about 1.5 times tangible book value. We think that continues to trend back up towards 2 times. And we think that picks up in the second half of this year. So we're real excited about the opportunity with M&A activity in the second half of the year. And then as we go into 2025, we think it continues to accelerate into 2025.
All right, great. Thanks. So I did want to ask you one more question.
Sure.
Just as we look at the market today, I think you're got a very good beat on rates and how those are going to impact performance. So I think the market maybe has priced in some rate cuts heading into 2024. We found out yesterday that we're not getting one of those cuts today.
Right.
Might be in the future. Can you just talk about what happens if we don't see those anticipated rate cuts that might be impacting prices from last year and where it goes in the future?
Right. So it's real interesting because when people think about rate cuts in the banks, they think that the banks need rate cuts to be profitable or be more profitable than they were in 2023. And that's not really true. A lot of the banks have repositioned their balance sheets to be asset neutral. So a lot of them were asset sensitive, where they needed rates to increase to make more money. And thus, if rates were coming down, they actually would make less money at first when rates start coming down. The banks have had over a year to kind of position themselves to be a little more neutral. So if we stay where we're at now at interest rates, and that would continue to see the portfolio rate higher as far as the average yields on those portfolios, and you're going to see the cost of deposits kind of level out. The banks can actually increase their earnings if we just maintain kind of a neutral interest rate state here. So if we don't see it go up and we don't see it come down, that's actually not bad for banks. If we start to see the rates down, you start to see some more lending activity, and there'll be a slight change. You know, some of the banks that are asset sensitive will get a negative minute. Some of the banks that are a little more asset liability sensitive will see a benefit, actually. So it's according to how the balance sheet is positioned.
All right, great. Well, hey, thanks for your time today, Steve. I appreciate you giving me a few minutes to talk
Sure
in between the sessions here, and we'll let you get back to it. But thanks everybody else for watching online, and stay tuned for more interviews.
Great. Thank you.